Hi, I'm Scott Flaherty, CEO of LendSmart Mortgage, and welcome to another episode of Mortgage Q&A. Today's question is, what is PMI? Well, PMI stands for Private Mortgage Insurance. When is it needed? Well, you need to obtain PMI on a conventional loan when you're borrowing more than 80% of the value of the property. So what it is, as the name implies, is in essence an insurance policy that protects the servicer in case of a loss and default. So in theory, if there were to be a default on the loan and the mortgage goes into foreclosure and there's a loss on the servicer side, the insurance policy would pay a portion of that loss back to the servicer. So the great thing about this is, I guess for you, is that you get to pay for this through your monthly payments. Let's take a look at how mortgage insurance is calculated. Your mortgage insurance premium will be slightly different depending upon how much money that you're borrowing in relation to the value of your home. So if you're borrowing 95% of the value of your home, your mortgage insurance premium is going to be slightly higher than if you were borrowing 85% of the value of your home. Let's take a look at an example here to illustrate how this affects your mortgage payment. So let's say that your purchase price on your new home is $300,000 and you're putting down 10% or $30,000. That would leave you with a $270,000 loan amount and a 90% LTV. Now, your MI factor will vary based upon things such as your credit score, but let's just say that a typical MI factor for this 90% loan would be 0.41%. How you calculate your mortgage insurance would be to take your $270,000 loan amount, multiply it times 0.41%, which equals $1,107. That's your yearly premium divided by 12 months would give you $92.25. That $92.25 would be added to your principal and interest payment before we add in your taxes and your insurance to get your full payment. So we've been talking about mortgage insurance, or PMI, on conventional loans to this point. There's also mortgage insurance on some government loans, such as FHA loans as well. Now, it's calculated a little bit differently on FHA loans. You have to pay both an upfront mortgage insurance premium and a monthly mortgage insurance premium when it comes to FHA loans. However, the upfront MI is financed into your loan amount, and the monthly MI is generally cheaper than most conventional loans. But it can get a little complicated. You'll definitely want to talk to one of our local professionals to figure out exactly what type of loan would be best for you and how the mortgage insurance would work. Certainly you can click subscribe below to see any of our other videos. And as always, remember to be smart, choose LendSmart.